Here's the deal. If you're single and pulling in over $168,000 a year, or you're married filing jointly and your household income tops $252,000, then in 2026, the IRS says you can't put money directly into a Roth IRA. End of story. But there's a workaround. It's completely legal. It lives right inside the existing IRS tax code. And it lets you get that money into a Roth IRA anyway. It's called the Backdoor Roth IRA. I'm Gino. Today, the mechanics, the tax rules, and the trap that catches 90% of people off guard. If you're already on board with the Backdoor Roth, or just thinking about it, this video's got everything you need. Alright, let's jump in. If you watched the last video, we talked about the Roth conversion ladder. That's the strategy for getting money out of your 401k before 59.5 without paying penalties. This episode is its little brother, the Backdoor Roth IRA. The ladder is about getting money out. The backdoor is about getting money in. 3 things we're covering today. 1. Who needs this strategy and who doesn't? 2. The 3-step process that seems easy, but has one trap that catches 90% of people off guard. And 3, why a lot of people end up paying way more tax than they should on their backdoor, and how to make sure you're not one of them. So, first question. Do you actually need a backdoor Roth? Here are the numbers for 2026. If you're single and your Maggie is under $153,000, you can fully contribute to a Roth IRA directly. No backdoor needed. If you're between $153,000 and $168,000, you can still contribute some, but not all. Still no backdoor needed. But if you're over $168,000, you're out. You cannot contribute directly. For married couples filing jointly, the numbers are higher. Under $242,000, you're good. Between $242,000 and $252,000, you can contribute partially. Over $252,000, you're locked out. And one more group, married filing separately. That one has very low limits. So most high earners in that category end up needing the backdoor too. Now, here's the workaround. The IRS lets you contribute to a traditional IRA first, and then convert that money to a Roth IRA. That's the backdoor. So who doesn't need this? If your income is comfortably below those limits, just contribute directly to the Roth and skip the extra paperwork. If you're in that partial contribution range, same thing. You're fine. The backdoor is really only for people whose income fully exceeds the limit. Alright, so how does this actually work? On paper, it's pretty simple. Step 1, open a traditional IRA account. Step 2, put money in. That's the contribution. And here's the key. It's after tax. Non-deductible. For 2026, the limit is $7,500 if you're under 50, and $8,600 if you're 50 or older. Step 3. Convert it to a Roth IRA. That's it. 3 steps. Sounds easy, right? Now, one quick tip. Don't let that money sit in the traditional IRA. Convert it as soon as possible. Why? Because if it earns anything, even a few bucks in interest, before you convert, that earning becomes taxable. Not a huge deal, but it's unnecessary. So just convert it right away. But here's the thing. Most people stop here. They think, that's it, I'm done. And they completely miss the fatal mistake that comes next. Now here's where it gets dangerous. This is the single most deadly and most overlooked trap in the entire Backdoor Roth IRA strategy. It's called the Pro-Rata Rule. So what is this rule? Here's what the IRS says. When you do a Roth conversion, you don't get to pick and choose which dollars you convert. You can't just say, I'm only converting my after-tax money. Instead, the IRS looks at all your traditional IRA accounts, including rollover IRAs, SEP IRAs, and simple IRAs, and treats them as one big pool. And then they calculate everything proportionally. Let me show you what that looks like in real life. Meet Mike. Mike has $200,000 sitting in a traditional IRA. That money is pre-tax. He rolled it over from an old 401k. Now Mike wants to do a backdoor Roth, so he contributes $7,500 after tax into that same traditional IRA. So now Mike's total IRA balance is $207,500. Of that, $200,000 is pre-tax. That's 96.4%. $7,500 is after tax. That's 3.6%. Now Mike converts $7,500 to a Roth IRA. He thinks it's tax-free because he just put in after-tax money. But the IRS doesn't see it that way. They say, Mike, you're not just converting that $7,500 of after-tax money, you're converting a proportional mix of everything. So here's what actually happens. Of that $7,500 conversion, 3.6% is tax-free. That's about $270. The other 96.4%, that's $7,230 is taxable. Mike thought he was doing a tax-free backdoor, but in reality, $7,230 of his $7,500 conversion is getting taxed. At a 32% tax rate, that's roughly $2,300 in taxes he didn't expect to pay. And just to be clear, when I say overpays, I mean compared to if his IRA balance was zero. If Mike had zeroed out his IRA first, all of that tax could have been completely avoided. And here's the kicker. The IRS won't warn you about this. Your broker won't warn you about this. Nobody's going to flag it. You have to catch it yourself. Now, before we move on, I need to clear up something that confuses a lot of people. There are two completely different 5-year rules, and they do totally different things. Rule number 1. The Roth account has to be open for 5 years. This one determines whether your earnings come out tax-free. Rule number 2. Each conversion has its own 5-year clock. This one determines whether you pay the 10% penalty if you withdraw early. Two different rules, two different purposes. Now, here's the key distinction for your backdoor. And there's one crucial rule you absolutely need to understand before you even think about withdrawing. The $7,500 conversion has 2 layers. $270 is after-tax principal. That part is penalty-free, no strings attached. And $7,230 is pre-tax principal. That part has a 5-year clock. Here's the catch, and this is where people get burned. IRS ordering rules determine the sequence in which money leaves your Roth IRA. You don't get to choose which layer comes out first. The $7,230 taxable conversion portion, the one with the 5-year clock, must come out before the $270 non-taxable portion can be touched. So if you take a $1,000 withdrawal tomorrow, the IRS treats that as coming from the $7,230 taxable bucket first, not from the $270 safe bucket. The safe money stays locked behind the taxable money until you've fully exhausted the taxable portion. That means if you need $270 in cash and think you can just grab the safe portion, you can't. The ordering rules don't work that way. Any withdrawal you take from this conversion will first be allocated to the $7,230 taxable portion until it's fully depleted. So yes, $270 is truly tax-free, penalty-free, and not subject to the 5-year rule. But you can only access it after you've worked through all the $7,230 of taxable conversion principal first. So why does this happen? Because the IRS treats all your traditional IRA accounts as one big pool, you don't get to pick and choose which dollars to convert. It's all or nothing. If you've got pre-tax money sitting in there, it's going to get mixed in. Now here's the bigger problem. This isn't a one-time thing. A lot of people do backdoors year after year, and they have no idea they're paying extra taxes every single time. Let's walk through it. Same Mike. He does a backdoor every year, and his traditional IRA balance stays right around $200,000. He never zeroes it out. He contributes $7,500 each year, converts it, and every single year, about 96.4% of that conversion gets taxed. So based on a static estimate, keeping that IRA balance at $200,000, he's paying roughly $2,300 in extra taxes every year. Over 5 years, that's over $11,000. Now, to be fair, actual tax liability will fluctuate. Account values go up and down. You might add more money. So this number isn't fixed. But the direction is crystal clear. The larger your IRA balance, the heavier the tax burden. And if you keep doing backdoors without zeroing out that IRA, that money keeps getting taxed year after year. All right, so now the big question. What if you already have a traditional IRA balance? Are you just out of luck? No, there's a solution, and it's actually the cleanest one. Option 1. Roll your traditional IRA into your current employer's 401k, if they allow it. Here's how it works. You take that pre-tax money sitting in your traditional IRA and move it into your 401k. Once you do that, your traditional IRA balance drops to zero. And when your IRA balance is zero, the Pro-Rata Rule no longer applies. Your backdoor conversion becomes completely tax-free. Now, there's one catch. Timing. The IRS looks at your IRA balance on December 31st. So if you want to avoid pro-rata for that year, that rollover needs to be completed by December 31st, not January 1st, not around the end of the year. December 31st. Now, here's something a lot of people get confused about. The backdoor contribution itself. You can actually make that as late as the April tax filing deadline. That's flexible, but the IRA balance that matters for pro-rata is locked in on December 31st. So if your goal is a clean tax-free conversion, that rollover has to happen before the calendar flips. One more thing to keep in mind. Your 401k and your IRA might have different investment options and different fees. So before you roll over, take a minute to weigh the trade-offs. Make sure it makes sense for your situation. But if you can do it, roll it over, zero out that IRA balance, and then do your backdoor Roth. Completely tax-free, clean and simple. Now, if rolling into a 401k isn't an option, maybe your employer doesn't allow it, or you just don't want to. There's a second path. Option 2. Accept the tax and convert gradually. If your pre-tax IRA balance is small, or you're okay with paying some tax now, you can just do the backdoor and accept that a portion of it will be taxable. But, and this is a big but, you absolutely must file Form 8606 every single year. That form tracks your basis, the after-tax money you've already paid tax on. If you forget to file it, the IRS could end up taxing that same money again in the future, and nobody wants to pay tax twice on the same dollars. So let's talk about who this strategy actually fits, and who should just stay away. The backdoor fits you if your income is over the Roth IRA direct contribution limit. That's the whole reason we're here. It fits you if your traditional IRA balance is zero, or you're planning to zero it out by the end of the year. It fits you if you're comfortable with the contribution limits. $7,500 if you're under 50. $8,600 if you're 50 or older. And it fits you if you're willing to file Form 8606 every year. It's not complicated, but you have to do it. Now, on the flip side, the backdoor is not for you if you have a large pre-tax balance sitting in a traditional IRA, SEP IRA, or simple IRA. That pro-rata math will eat you alive. It's not for you if your 401k won't accept a rollover and you can't zero out that IRA balance. It's also not for you if the rollover is possible, but your 401k has terrible investment options or high fees. Sometimes the cure is worse than the disease. And honestly, if you just don't want to deal with the complexity of pro-rata, that's a valid reason too. It's not for everyone. All right, let's put this side by side so you can see the difference clearly. Scenario A, no pro-rata. Your traditional IRA balance is zero. You contribute $7,500 after tax to a traditional IRA. Then you convert it to a Roth IRA. How much tax do you pay? Zero. Nothing. Your effective tax rate is 0%. That's the clean, ideal situation. Scenario B, with pro-rata. Your traditional IRA balance is $200,000. Same move. You contribute $7,500 after tax, convert it to a Roth. But this time, about $7,000. $230 of that conversion is taxable at a 32% tax rate. That's roughly $2,300 in taxes you weren't planning to pay. So the difference is about $2,300 per year. And if you're doing this year after year, that adds up quickly. Based on a static estimate, keeping that IRA balance at $200,000 over 5 years. You're looking at more than $11,000 in extra taxes. Same contribution, same conversion, but one scenario is completely tax-free, and the other costs you thousands. The only difference? That IRA balance sitting there before you start. Let's lock in the key numbers for 2026. If you're under 50, the Roth IRA direct contribution limit is $7,500 per year. If you're 50 or older, it's $8,600. For income limits, if you're single and your Maggie hits $168,000 or more, you can't contribute directly. For married filing jointly, that number is $252,000. One date you need to remember: December 31st. That's the day the IRS looks at your IRA balance. If you're trying to zero it out to avoid pro-rata, it has to be done by that date. And the form you absolutely can't forget: Form 8606. You need to file this every single year you do a backdoor to track your after-tax basis. Here's a simple 3-step decision framework. Step 1. Does your income exceed the Roth IRA direct contribution limit? If not, you don't need any of this. Just contribute directly to a Roth IRA and move on with your life. But if your income is over the limit, keep going. Step 2. What's your traditional IRA balance right now? And I mean all of them, including SEP and simple IRAs. If that balance is zero, congratulations. The backdoor is a great fit for you. Completely tax-free. You're good to go. But if you do have a balance, you're not done yet. Move to Step 3. Step 3. Can you roll that pre-tax IRA balance into your current 401k? If yes, do that rollover first. And make sure it's done by December 31st. Then do your backdoor, clean and tax-free. If you can't roll it over, maybe your 401k doesn't allow it, or you just don't want to, then proceed with caution. Weigh the tax cost carefully before you move forward. 3 steps. That's it. Follow this framework and you'll know exactly where you stand. I'm Gino. Next episode, we're covering the Mega Backdoor Roth. How to expand your annual limit from $7,500 to $47,500. See you then. Drop a comment below. Do you have a traditional IRA balance? Have you run into the pro-rata trap?